Thank you very much, Alex, and thank you very much, Laurie. I'm very happy to be here today to talk about neurodiversity, an aspect of diversity and inclusion, which is gaining increasing attention and which we're learning to recognise not as a disability, but as a cognitive distinction in both senses of the word. So neurodiversity can be looked at not just as a D&I issue, but also as a business and transformation tool and asset. And more of that in a few minutes. But let me start by explaining why, as regulators, we, along with the Bank of England and the Prudential Regulation Authority, have an important role in promoting D&I in financial services. We have two starting points. Number one, the financial services sector is not diverse and inclusive. And number two, diversity and inclusion is a good thing for firms and for the consumers and markets they serve. Let me give you a few figures to demonstrate the first starting point, the lack of diversity in financial services. The latest update on the Parker Review, which recommended about 5 years ago that by the end of December 2021, all FTSE 100 companies should have appointed at least one ethnic minority member, shows that most of them have. 94 out of 100 have done that. Now, this is good news. However, most people of colour are in NED positions, and only 6 CEOs come from a minority ethnic background and only 3 chairs. In October 2021, Reuters analysed 21 major financial institutions and found that the major banks had made only a slight dent in their gender pay gaps since the previous year, while several insurers went backwards. And women in banking and finance calculate that at the present rates of progress, it will take 30 years to reach gender parity in financial services. Now, this lack of diversity must feed through into outcomes for consumers. For example, the Citizens' Advice Report on Discriminatory Pricing in Insurance, published on the 22nd of March, highlighted the risk of discrimination based on race and raises important and challenging questions for the insurance industry. And last month's report from the Money and Mental Health Policy Institute looked at the provision of essential services, including financial services, for people with mental health problems. It found that only 29% of people with mental health problems say that essential service providers anticipate their needs. All of these facts and figures run counter to the literature, which says that D&I is a good thing for financial services firms and their customers and markets, that it can have beneficial business outcomes. Research demonstrates that diversity and inclusion can lead to better outcomes in risk management, to better conduct and therefore lower regulatory fines, to healthier working cultures and increased well-being, and to more creativity and innovation. It makes it easier to attract and retain talent. The diversity of thought that comes with demographic diversity and with true inclusion can lead to better decision-making, and decision-making that reflects the needs of different communities. All of that explains why we, together with the bank and the PRA, published our discussion paper on D&I in regulated firms last summer. We will publish a consultation paper this summer, which is another opportunity to join the conversation. And about 6 months after that, we'll publish a policy statement, which is the thing that sets out the new rules, requirements and guidance that we expect firms to abide by. Now, the outcomes that we want to see from this work are clear and simple. We do want to see more diverse representation in regulated firms, but not just for its own sake. This isn't a numbers game. Through inclusion and diversity of thought, we want to see the benefits of greater representation feed through into better consumer and market outcomes, into products and services which are designed for a diverse range of consumers and which reach them in a fair and accessible way. And we want to see better data collection and more transparency of data, because without the data, we are nothing when it comes to D&I. So our key message is that we take D&I seriously and we expect regulated firms to do the same. Ask yourself, if the proposals in our discussion paper were to make it into a new set of rules and guidance at the end of this year or the beginning of next, how ready would your firm be? We are well aware that as an employer, we're on a journey ourselves when it comes to diversity and inclusion. You can see it in our annual diversity report, you can see it in our ethnicity action plan, you can see it in our pay gap data. And that's why we started this conversation with a discussion paper, rather than going straight to consultation paper stage. We wanted a genuinely open conversation with as much time as possible for people to give us feedback. We don't have all the answers, but we are part of an ecosystem which can play an important role in driving positive change. And we have a statutory responsibility to get things right for consumers and markets. In this context, it's important to know that this drive for D&I in financial services hasn't come out of nowhere. It aligns with our long-standing work on treating customers fairly and on vulnerable consumers and fair pricing, and with our emerging work on the new consumer duty. And of course, as ESG rises up the agenda, it will take D&I with it. Now, you will have noticed that I haven't so far said anything specifically about neurodiversity, mainly because data on how neurodiverse financial services is, in terms of management, employees or customers, just isn't really there. Secondly, maybe also because neurodivergence is not specifically called out as a protected characteristic in the Equality Act 2010. This in itself raises D&I challenges. Some neurodivergent colleagues might recognise themselves in the definition of disability in the Equality Act, and some may not. The repercussions of this are that employers might not understand the application of the Act to neurodivergent colleagues, and those neurodivergent colleagues might feel that they don't belong to any particular group and might not feel included in any corporate initiatives aimed at the disabled, for example. And thirdly, maybe because neurodiversity can be invisible some or all of the time, or successfully masked some or all of the time. Despite or because of this, some of the feedback to RDP has urged us not to forget the importance of neurodiversity in financial services. Again, the figures speak for themselves, and Laurie touched on this in his remarks. ACAS figures say that about 1 in 7 people is neurodivergent, but neurodivergent people are one of the groups in society most likely to be unemployed or underemployed. ONS figures show that just 22% of autistic adults, for example, are in any kind of employment. This is doubly troubling because for many neurodivergent people, employment can be helpful by providing structure and purpose and social interaction. However, I think there are 3 reasons for optimism. The first is that there are good reasons to employ neurodivergent people. The second is that there are some very simple, low-cost things you can do to bring in and get the best from neurodivergent people. And the third is that the responses to RDP show that there is some really good D&I practice out there. On the first, those who employ neurodivergent people say that they are detail-oriented, analytical, good at pattern recognition and information processing. They thrive on predictability, they are tenacious and loyal. They can be great at innovation, systems thinking, and problem solving. This often leads people to conclude that neurodivergent people are therefore great for filling the STEM talent gap. But there are also great examples of neurodivergent people thriving in the creative industries, especially art, performing art, and music. And studies show that autistic professionals can be up to 140% more productive than the average employee when they are in a job that matches their skill sets and interests. The experience of EY, which has 300 people in 13 neurodiversity centres of excellence around the world, suggests that neurodiversity has added about $1 billion of value to its business through new solutions, media recognition and branding, stakeholder relations, and so on. And that millions of hours have been freed up through those new solutions. They have also found really high retention rates among neurodivergent colleagues, all of which is good for business. Now, Laurie also touched on talent. The Future Skills Report from the Financial Services Skills Council in March identifies 5 skills gaps for the industry: data analytics and insights, software development, creative thinking, data literacy, and coaching. And at the risk of stereotyping and pigeonholing neurodivergent colleagues, it is clear that they can make an important contribution to filling these skills gaps. On the second point about doing things to encourage and keep a neurodiverse workforce, forward-thinking organisations are looking at their employee lifestyle and making changes. And as Laurie said, sometimes these are minor adjustments, and most of them are good for the neurodivergent and the neurotypical. Things like making it clear that neurodivergent people are welcome to apply for jobs, drafting job descriptions and interview questions so that they focus on essential skills, providing interview questions in advance so that you're testing knowledge and experience rather than the ability to make things up on the spot, hiring and training in small cohorts to create instant communities, pairing people up with an office buddy and a counsellor, providing reading materials in advance of meetings, appraising quality of work and outputs rather than more subjective things such as polish, and designing working environments with neurodiversity inclusion in mind, which is something that we did when we built our new offices in Stratford a few years ago. It must be clear to you that all of these things are good business practice, but they also require strong management and leadership. As leaders of a neurodiverse workforce, we'll need to be able to be clear and succinct about the purpose of our work. We need to run our meetings in a structured and inclusive way. We need to be prepared to receive honest and direct questions and feedback. And when we give feedback, we need to be succinct and intentional. We need to be prepared for leading people who might be quicker than us at finding solutions to complex problems. And neurotypical people need to be active allies, raising awareness, checking that policies, processes and systems are inclusive and that neurodiverse colleagues are involved in their design and maintenance, calling out bad behaviours and so on. On the third point about good practices, one of the joys of doing a discussion paper is that respondents sometimes use it as an opportunity to tell you about all the good things that they're already doing, which I welcome. And three things have really stuck in my memory from those responses. First, reverse mentoring. For example, a junior colleague who is neurodivergent can mentor a more senior colleague who is neurotypical as a way of sharing experiences. Secondly, shadow boards, where boards made up of more junior and more diverse colleagues contribute to board decisions, whether by attending board meetings or giving views on board papers. And third, getting the customer in the room, which is about literally or metaphorically getting customer views and experiences actively fed into strategic decisions about the design and delivery of products and services. And getting all of this right is particularly important in a challenging hybrid working environment. But the bottom line is that as leaders and as an industry, we need to create psychologically safe environments. This brings me neatly back to the unique role of regulators. The FCA is a conduct regulator, and as part of our long-standing work on culture in financial services firms, we have emphasised the importance of creating speak up, listen up cultures, of creating psychologically safe environments, because we recognise that these are important contributory factors when it comes to better outcomes for consumers of financial services.